You are listening to Mining Stock Education.
The entire theme, undercurrent in this conference was national defense. We, the United States, we are going to re-industrialize because we want to be self-sufficient in critical industries, be they national defense like drones or robotics or AI, or critical materials like battery production. And I would argue that that narrative of national defense has now permeated the junior mining and the mining world as well, right? So the narrative has shifted.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Chris Berry, president of House Martin Partners and host of the Power Current podcast. On today's show, you are going to hear Chris's views on the recent DOD investment in MP materials, rare earth pricing, the net zero narrative, the lithium market, and a little bit on AI. Chris, it's great to have you. Let's start with the most... Sorry,
great to be here.
Let's start with the most recent news flow. The US DOD is making an investment in MP materials. They're giving them a multi-billion-dollar commitment, 10-year price floor, equity position. But this deal is just with one company. It still leaves a gaping hole in terms of what I can see, in terms of what they need. What do you think of the deal, and where do we go from here?
On balance, I like it. Look, I would much rather be sitting here today discussing the pros and cons of this deal than not having any deal to discuss. I feel like I've been focused on, focused on the critical metals, critical materials world for the last 15 years. And I can't tell you how many times, here's another white paper that comes out of a think tank in DC talking about these vulnerabilities, and here's what we need to do. So there's been a lot of talk and a lot of ink spilled, but there hasn't really been very many checks written. That did start to change under the Biden administration, I think initially, and has accelerated now under Trump. Specifically, as to your point, I think this MP deal with the Department of Defense is in many ways transformational. It's certainly unique, right? I mean, I think you could look at this and say that we're watching a movie that we've never seen before, in the sense that, the risk appetite of the United States government, or specifically of the Department of Defense, has broadened or widened considerably. I think it's one thing for the DOD or the Defense Logistics Agency or whoever it is to say, okay, we will stand there for an offtake, or we will take material off your hands, or whatever it is. But to your point, to make a $400 million preferred equity investment and then a $150 million loan investment or offering, coupled with, I think it's JP Morgan and Goldman Sachs offering $1 billion in debt, really is a new sort of way, I think, of thinking about how to rebuild the defense industrial base with both a public and a private partnership here. So that's all great. But I think, the biggest surprise, or the biggest surprise to me was the $110 per kilogram floor on NdPr. When the market today is at 60, again, in the last 15 years, NdPr has only been at or above $110 per kilogram twice, and that was during the previous two boom and bust cycles. You do wonder, okay, so where is 110 the new floor? Is this just something that the Pentagon is saying, listen, we need this material, we really need MP materials to succeed, and so they're willing to pay a pretty hefty premium for that material. So anyways, I could go on, we can get into more details, but on balance, I think it's a good deal. Certainly controversial because, the Adam Smith acolytes out there, the invisible hand folks, will say, well, this is just, the government picking winners. And I think there is validity to that argument. But that said, if it's not MP, who else would the U.S. government rely on or go to get any kind of magnet feedstock anytime in the next, say, 5 to 10 years? I would argue most of MP's competitors domestically, or let's broaden it out and say even in North America, so up in Canada, a lot of their competitors are a number of years behind where MP is today. And so having said that, I think MP was really the only game in town. But again, the biggest surprise to me, again, aside from that price floor, is just the quantum of capital and the appetite for risk that the DOD is clearly embracing going forward.
Right. I think for me, the scary part is government getting involved in any sort of, especially mining. Like I've seen how many projects have not worked in the past, and be taking an equity position. And, we talked about that price floor and stuff. It seems like a lot of risk that my experience with government, that they have probably no idea how much risk they're actually taking. And that's just my personal experience from talking to government officials.
Sure.
But it's interesting. So let's talk about the pricing. Like I've looked myself into rare earths pricing. It's got to be one of the most opaque markets I've seen. And I'm not even really sure. I've been asking companies, junior companies, about pricing, and they've been providing me with data because I don't know where to find it. So how does the pricing work for rare earths, and where could people track that pricing?
I mean, this is a China dominated market, right? I mean, that's an obvious statement. There's nothing new there, I think, that we don't already know. But because China controls the majority of the entirety of the supply chain, mining, refining, and of course, magnet manufacturing, where they own about 90% of that market, the China price is the price. And so, in terms of where to get the pricing, I mean, you're sort of reduced to, just from a Western perspective, you sort of have to take what MP or Linus or some of these, to your point, some of the junior mining companies, the data that they're aggregating, but you really do sort of need to be on the ground, I would argue, in China, looking at the cost of production of some of these players. And again, that's a difficult thing to do in China because cost of production can be clouded, right? It can be clouded because of subsidies. It can be clouded because for any number of reasons. I mean, there's no incentive necessarily for some of these companies to really talk about, their own cost of production and the prices that they're getting. And so it's very difficult. I would say that, again, coming back to that $110 per kilogram number, I'm not sure how that was derived or come about, but kudos to the MP management team for locking that in. I would love to be sitting here with you in, 3 or 4 or 5 years, and we are well above that number for NdPr. And we could be, I'm not necessarily here to forecast that, but that is a very, very aggressive number. So, maybe just to come back to your question, where do you get the pricing from? We are for a number of years, I think, still going to be reliant on the data coming out of China, simply because you just don't have that production capacity or magnet making capacity at scale yet outside of China, and to a far lesser extent, Japan. And so because of that, China is going to continue to set the price for a number of years going forward.
And how do you see, definitely the narrative has been US centric. But obviously, in terms of project development, there's a number of projects around the world, some in what you would call, I guess, G7 or maybe friendlies to the US, whatever that means in a tariff world. But do you think the U.S. is going to have to look outside of its borders to expand this rare earth supply?
Well, we certainly could. I mean, there are a number of projects in Canada that have been developed and recycled and are in the process of being developed again. They could perhaps partner with MP. I mean, who knows, and there are a number of projects even in the United States. Again, we all know that rare earths aren't rare. I mean, that phrase has been kicked around for years. It's the separation capacity and the know-how, the IP, right, that I think is rare and very, very challenging. And again, that, if you think about what we talked about, Chinese dominance of the supply chain, I really think they are dominant in the IP more than anything else. And so, when you think about risks to developing a domestic supply chain, again, it's great that the DOD is there and they're going to put a bazooka's worth of capital towards MP to try to get a vertically integrated project. But it's going to be very difficult, I would argue, even with government help, for other projects to try and match that in any reasonable time frame. Okay. And you could say the same thing for some projects in Europe. I mean, there is a little bit of magnet making capacity in Europe as well, but it's just going to take a number of years, I think, before we know if this deal that we're discussing right now is actually ultimately successful.
Right. And so when you talk about IP, you're talking about that secondary refinement portion of it where you're taking.
Yeah, the separation and purification. I would say it's not a state secret in China, but I would argue that Chinese interests have been separating and purifying rare earths for much longer than we have here in the West. I would argue a lot of the physical, the human capital in terms of knowing how to do that, quite frankly, is, a lot of these guys are 90 years old. And when the supply chain was outsourced in the 80s and 90s and 2000s, that's where a lot of the IP went. And so now we sort of have to reconvene, I guess, a lot of these folks and the next generation as well to try and bring that back, because that really is the crucial piece.
Okay. And so in terms of like the mineral processing, is there that big of a variation between each mining operation out there that they almost need individual processes? So when you're talking about funding a mining operation, really it's a fully integrated process basically per mining operation, or could you have a central hub?
There's some debate about that. I personally think that, most of these rare earth projects are special or they're unique in their own way. And what that means is, in general, your flow sheet, your separation process, whether or not you're using solvent extraction, the different reagents and chemicals you're using, is going to be different. And so the flow sheet, for example, that has been used and perfected at Mountain Pass, is not likely to work if you were to effectively just take that and try and plunk it at another project, regardless of whether or not it's in the United States or Europe or what have you. So, one of the challenges, of course, is you need unique processing per project, right? And so I think one of the ways to make sure that you have a project that can last the cycles is obviously have a grade and tonnage, all the basics around what a good, mining project actually means. But, when you think about rare earths, it's less sort of bulk tonnage and just heap leaching. And these really are very detailed, unique chemical processing operations. I mean, the separation process is multi step. It's not like I have 17 rare earths, so there are 17 steps to separate each one. There are hundreds. Okay. And they can in many ways differ from project to project. So I'm not trying to scare anybody off or away. We can certainly do this, but you do have to go in with your eyes wide open that it's very, very risky to try and understand the mineralogy and metallurgy of a lot of these projects.
Right. Where do you see the opportunity in rare earths? Is it at the equity level? Like, is there something in the public market that interested investors should look at, or where's that opportunity?
Yeah, it's interesting. I struggle with this question, right? Because again, at $60 a kilogram, which is where, and we're just talking about NdPr, right? You have to think about, if you really want to understand the economics of a rare earth project, you have to look at it from a basket perspective, right? You have to say, okay, here's my project. I have 15, 16, 17 rare earths of different grade and different amounts, right? That could be measured in ppm or whatever, in my project. And so you have to look at the size of the project and the relative grades and weights of each of the rare earths in that project to try and derive a basket value. And then you have to compare and contrast that basket value with where the market is for each one of these specific rare earths. And because of that, with where, some of the prices are today, without external help, without external support, i.e., the Department of Defense or the government or the European Union, I'm just not sure how much of these ex-China projects are going to get built today, right? And that is even in the face of very clear, strong, robust demand signals, whether or not it's for electric vehicles or permanent magnets in robotics or whatever the narrative is. That's the irony, right? Which is the demand side of this whole equation, I would argue, is very, very strong. But from a supply perspective, again, you're looking at multi-billion dollars in CapEx and OpEx that can fluctuate wildly, again, based on the fact that there really is one provider of price in this whole dynamic, and that one provider is China. And so unless you can have an MP DOD style deal, right, where you're effectively guaranteed a floor for 2 of the 15 critical materials, critical rare earths, I just think it's really, really difficult to make an investment case here. So I'm not saying run away from it. I would argue that, you want to look at each one of these projects, really understand the basket value and the pros and the cons. There are other nuances like, well, what is the host rock? Is it bastnasite? Is it xenotime? I mean, that can also factor into your cost structure. But, without, again, I call it external support. Again, that could be coming from government or even state level or something like that here in the United States, or province level in Canada. I just think it's going to be really, really difficult to not just build the mine capacity, but the separation capacity and ultimately the magnet making capacity that is the ultimate prize.
Right. What's your view on the net carbon emissions narrative? With Trump's election, things, I think I would say definitively things have changed narratively, but what's the reality of it?
It's funny. 2 weeks ago, I was in Germany looking at a lithium project and talking to the management team. It's pretty well advanced, a lot of investors, offtakes, ticks a lot of the boxes, right? And you look at their PowerPoint, you look at their pitch deck, and you flip through page 1, which is, cautionary statement or whatever it is. And then the first page is net zero carbon lithium, et cetera, right? And then they get into the details about the numbers and capital structure and supply and demand. Okay. And that's totally fine. And that is the way things were across the entire critical mineral space from, say, 2017 to sort of 2021, right? The Biden years. Earlier this week, I was in Detroit at a conference called Re-industrialize. Okay. And the theme of the conference was, okay, China is kicking our butts. We need to bring advanced manufacturing, critical material processing back on shore, and we are going to do it. Right. And so again, it's a public-private partnership, but the narrative, I didn't hear ESG mentioned once. I didn't hear net zero. I didn't hear low carbon mentioned once. The entire, not overhang, but the entire theme, undercurrent in this conference was national defense. The United States, we are going to reindustrialize because we want to be self-sufficient in critical industries, be they national defense like drones or robotics or AI, or critical materials like battery production. So and I would argue that narrative of national defense has now permeated the junior mining and the mining world as well, right? So the narrative has shifted. I would argue actually that even during the Biden administration, what I saw was this blending of national and economic security, right? They were both important, both imperatives. ESG was a part of that. But now it seems like while ESG is important, again, it's not slide 3 in the deck. Now it's way back, and slide 3 is a picture of, an eagle and an F-15 and a missile and an American flag. And I'm being facetious for sure. But that is kind of the vibe, right? Like that is how I think the market is thinking about this. And of course, the MP deal, I know we started with this and we keep talking about it. That is only, I think, adding fuel to this fire. And just to be fair, the IRA is, I think, a question mark right now. I mean, the big, beautiful bill does really neuter it. In many ways from a demand side for some of these critical materials, and focuses a little bit more on the supply side. And so, you have seen the Department of Defense make investments, not equity investments, actually more of grants in domestic projects, like, for example, graphite through the Defense Production Act, Title III. And so, these aren't hundreds of millions of dollars of investment, but they're more like, $5 to $15 to $20 to $30 million to, for example, fund feasibility studies. So pushing it forward, which again, I think is very positive. But again, this is all being done under the guise of national defense and national security and self-sufficiency. And then, of course, I think the economic benefits flow through from there. But yeah, that narrative has definitely changed.
And how do you see, there's definitely some overlap in terms of the metals specifically that are affected by whether it's defense or critical minerals versus the net zero narrative. Which metals do you think are negatively impacted? The first one that comes to my mind and certainly certainly especially of yours, lithium seems to be more aligned with the net zero narrative. So would you say that it will be negatively impacted by like a market that's seemingly maybe further to the defense side of things?
Yeah, I don't necessarily think so, actually. I think that lithium still is at the epicenter of this whole narrative. Lithium and copper, I would say, are the two big ones, regardless of whether or not you're talking ESG or national defense. And look, going forward, I mean, there was just an article, I think, out on Reuters this morning, double-digit increases in EV demand, right? So, and I'm sorry to be vague there. I actually only saw the headline before we jumped on. But my point is, EV demand is still growing. Now, of course, the big push for some of these metals is around AI and data centers, which I think speaks to the need for copper, but also battery backup as well. The Trump administration is approaching a lot of this through this idea of energy dominance, right? They have an he has, I think, through an executive order, talked about an energy dominance council, which looks to me like the energy strategy, the source to power all of this is all of the above, right? It's coal, it's natural gas, it's oil. Not only is it drill, baby, drill, but it's dig, baby, dig, right? And so because of that, I think you could make a compelling case for demand for all of the energy metals. But again, the challenge is you sort of have to go one by one, say, lithium, copper, cobalt, nickel, etc. Then you run into the China market share and the China dominance story. And that's where it becomes a little bit more nuanced about what you want to do. But lithium is an oversupply right now. That is likely to continue, I think, through certainly this year and maybe into next year. I happen to think that the lithium market is tighter than one would believe. I mean, just yesterday there were reports out of China of a very small lithium mine, somewhere around 10,000 tons a year of production going offline, and overnight lithium futures were up 3%. So, maybe it's just people hoping that, we've turned and we're at the bottom or something like that. Or maybe this market is much tighter than we think. If you have one or two large lithium mines run into technical challenges or slow their expansion or whatever it is, it's a much tighter market than I think the price would indicate. So I'm not here to tell you that I think we're going to be sitting here in 6 months and lithium is at, $15,000 or $20,000 a ton, up from the roughly 8,500 USD per ton it is today. I'm talking about lithium carbonate, but I do think we're at the bottom. And the demand backdrop, whether or not it's EVs or ESS or, backup with respect to data centers, I haven't seen a lot of weakness. I haven't seen the weakness that you would infer by reading some of the headlines. I mean, yes, it is true that some of the really beneficial parts of the Inflation Reduction Act from a demand side perspective, like for example, Section 30D, right, which is the $7,500 tax credit, that ends, I think, in September of 2025. So that goes away. And so, but some of the other parts, 45X, are still intact. They have been pulled forward in terms of when they're ultimately going to sunset. But nevertheless, there's still a lot, I think, to be reasonably optimistic about.
Right. I personally wondered, I was looking at a few specific lithium companies' share prices and they've spiked. And then across social media, you see, the bottom is in. And being an investor, like for the last, decade in the market, I definitely don't buy that until I see sustained. I wonder though, if this is sort of a piggyback off the defense minerals or the tariff narrative, like what's been going around in terms of, 50%, tariff on copper, and whether the market is jump starting and saying, well, lithium is obviously the next place to go because China is, if they're maybe not as much control of lithium as they are rare earths, but they certainly make up a huge percentage of it.
Yeah, I think, lithium is an oversupply in part because of what the Chinese are doing, right? The narrative is the Chinese are going to flood the market, and they always do this every cycle and crush prices and put Western producers and Western developers under pressure. And, that is part of what has happened. That is part of the reason why lithium is at $8,500 a ton right now, give or take. But, producers in Brazil are increasing production. SQM in Chile has been increasing production. So it's not just a China phenomenon that is kind of keeping a lid on the price. The bearish response, the other side of the coin, the devil's advocate to what we're seeing in lithium with the bump in the pricing here is, look, if the Chinese are willing to produce lithium at a loss, which is what arguably they have been for a while now, how does an increasing lithium price disincentivize them from curtailing production, right? It only marginally improves. It makes terrible economics not quite so terrible, but it doesn't disincentivize them to stop. So to your point, like when I see these bumps in lithium pricing or whatever it is, I'm happy to miss the first 10, 15, 20% move, to your point, to know, okay, maybe we've got something real here. We have evidence of mine closures or, battery energy storage deployments have really ripped harder than we thought they would. So again, still optimistic, but very, very kind of cautious when I see these bumps along the bottom. Might be a way to think about it.
Talking about supply, I thought one of the most interesting articles I read over the last couple months was this push for the super majors in oil and their interest in coming into the lithium market and talking about DLE, direct lithium extraction. How do you think this plays out? Because to me, if there was a bearish sign, this would be one of them.
That's one way to think about it for sure. And I would argue, the optimists take. And I'm more in the optimist camp on this one. Look, I mean, if we are going to build a lithium supply chain domestically, it's going to take capital and IP, right? And yes, time and political will and all of that other stuff. But, I was very pleased when, even in 2017, you saw, Lanxess partnering with Standard Lithium. And then, of course, since then, we've seen Exxon and Chevron and Equinor and Dearborn and some of these other super majors all put a flag in the ground, right? And say, okay, we're going to build a lithium business. And so from an oil super major perspective, it's very low cost, right? I mean, think about like the R&D budgets that some of these super majors have. I mean, it's arguably larger than the entire global lithium market. So it means it's not like they have hundreds of millions of dollars worth of market cap at stake. But, I'm very gratified and pleased to see, again, the Exxons, the Chevrons, the Equinors here, because they do have that IP in terms of extracting liquids from underneath the surface of the earth and purifying them. But they also have gigantic balance sheets. So they can weather the storm, whether or not lithium is at 80,000 or 8,000 or whatever it is. DLE in general, again, to sort of be fair on how to think about this, it hasn't yet lived up to its promise of higher recovery, substantially higher recovery rates, say from 50% for traditional brines to 90%. Lithium being produced in a matter of hours as opposed to months. Again, I'm not sure if that's a huge benefit. I guess that's helpful. And then lower CapEx because you don't need to use ponds for DLE. Well, when you look at the feasibility study for some of these advanced DLE projects, they do tend to rival traditional brine operations from a CapEx perspective. And I'm not taking swipes at anybody. I mean, look, if we want to build domestic capacity, be it DLE or hard rock or whatever, it's going to cost hundreds of millions, if not, billions of dollars to do it. And that's fine. And that's just the investment we need to make. But I think that DLE, again, not unlike brine, it's complex chemical engineering. This isn't just digging the ore out of the ground and crushing and grinding and beneficiating. So I think we'll get there. I would hope that you would see some domestic DLE production by 2030. Again, is that Standard Lithium? Is that privately held material? Is it E3 up in Alberta? Some of the geothermal players in California, who knows? Like there are some pretty advanced projects out there. So we're not there yet. But again, just like we talked earlier about the Energy Dominance Council and the all of the above approach, I would argue you need an all of the above approach in lithium as well. Hard rock, DLE, clay, brine, you name it.
So you don't think if DLE lives up to its I guess the idea of it, you don't see it affecting hard rock? Because I guess when I first read the first paper I ever read on DLE, I thought, oh wow, this will close the gap between brine operations and hard rock and make it that much more accessible or whatever. You don't see? Do you see any effect?
Not yet. And I'm happy to be proven wrong. And, if we do this call in a year or 2 years or 3 years, I hope I can come back and say, yeah, DLE really blew everything away. I'm not saying it won't. I'm just saying I need to see more evidence that we're on that path, right? I mean, DLE is used primarily for very complicated basins. Complicated meaning lower grade, higher impurities, right? Could be old oil wells, could be bromine waste streams, what have you. And so again, when I talked earlier about it being complicated chemical engineering, that's what I'm referring to. You have to have a very unique, efficient, and scaled process to pluck, 100 milligrams, 200 milligrams lithium per liter out of these waste streams. I'm actually and continue to be quite bullish on hard rock from a global perspective, if for no other reason than, yes, it's slightly higher cost than brine. I would argue that hard rock, I think where we're going on the cost curve, and DLE are roughly similar in costs. Again, that's not always an apples to apples comparison, but in general. And so if you think about hard rock lithium mining, and I don't care if it's from spodumene or lepidolite or petalite or what have you, it's traditional mining, right? As I mentioned before, it's crushing and grinding and flotation. We know how to do that. And when I think about the last two or three lithium booms and busts that have come about, the busts started with an increase in hard rock production. Okay. Bringing that spodumene on stream pulled the spodumene price down, which by extension pulled carbonate and hydroxide prices down with it. And, then we kind of bumped along the bottom until there was a new catalyst. So it's much easier, relatively speaking, to bring lithium hard rock on stream relative to brine or DLE. And because of that, and just because, again, lithium demand continues to grow at, 15 to 20% per year. So the demand is still there. And if you sort of were placing your bets and saying, okay, am I going to place a bet on complex chemical engineering at lower cost, better ESG footprint, or very straightforward mining and beneficiation at a higher cost and maybe a higher carbon footprint, where, by the way, for roughly the same cost, you can produce both carbonate and hydroxide, which you can't necessarily do on the brine side. I'm gonna lean towards hard rock for now. But again, happy to be hopefully proven wrong in the future.
Let's talk about pricing. I think lithium might be one of the most volatile in terms of the highs it's hit and possibly the lows that it's hit in terms of pricing over the last, let's say, 7 to 8 years. Do you think it's just a matter of time before we get a tighter volatility range in the lithium price? Or what will it take to get that tighter? Because you're always going to have volatility in metals markets, but it just seems like the highs that we had last bull cycle were extreme. And
they were ridiculous, right? I mean, $85,000. I mean, roughly, let's call it 80, just to round it down. I've never seen a commodity or a specialty chemical. You can call lithium what you want to call it, but I've never seen a commodity where every single mining asset in production or in development was economic on the cost curve, right? I mean, there's always going to be a limit. And of course, the highest cost lithium assets, sort of some of the hard rock in China is around $20,000 a ton. And you're telling me that the price is at 80? That doesn't make any sense, right? And to be fair, today I would argue at $8,500 a ton, where 40% of the cost curve is underwater, that is also unsustainable. So, from a pricing perspective, to answer your question directly, I think what you need is a much bigger lithium market. You need a much bigger, deeper lithium market with more participants willing to share pricing data and feed that into some sort of a central mechanism. And I don't necessarily think there will be a specific lithium price, either carbonate or hydroxide, just like there isn't today. I mean, you've got pricing in South America, you've got pricing in China, you've got pricing in the EU for a host of commodities too, right? It's not just lithium. So I would argue lithium is going to develop the same way. I do think that, what some of the hard rock players have done, like Albemarle and Pilbara Minerals, they'll do auctions. And so again, they're for very small lots, relatively speaking, but they will say, we auctioned off, I'll make up a number, 500 tons of battery grade carbonate. And here was the price. And that's a signal, right? That just tells the market, okay, here's where, regardless of what you see when you look at some of the consultant pricing mechanisms, here's what we, Albemarle or PLS, are seeing. And so that's valuable. And then I think you do have a burgeoning futures market, right, for lithium in particular, both in China and ex-China. And as those contracts gain popularity or get more liquidity, I think you can start to trust those prices more and more. And I'm not suggesting that you should not trust the prices that you see today. I'm simply saying, the deeper the market, the more liquidity there is, the more comfort I think you can have in the pricing, right? And so, copper is a 30 million ton a year market, and it fluctuates pretty wildly too. I mean, I guess I'm an old man, but I can remember when copper was 60 cents a pound. Doesn't seem like it was that long ago. I can remember, 10 years ago, a geologist in Vancouver said, man, I am so comfortable with $3 copper. You have no idea. And copper was at, $1.40, $1.50, $2. And here we are today, and at least in the United States, copper is at $5.50 a pound. Again, then you get into the argument around, well, it's the tariffs or it's export. It's a whole host of things. But my point is, pricing has gone one way in general over time, despite the liquidity, despite the volatility. So I think lithium ultimately is gonna play out the same way. But lithium today is about a 1.5 million ton a year market. I think by 2030, that doesn't quite double. I'm sure you'll have folks on the podcast that will tell you, it's going to go well above 3 million tons or whatever it is. And maybe it will. I just think the demand side, the supply side is going to have trouble matching up to that. So if we are at 2.7 million tons of demand, 2.8 million tons of demand by 2030, I think that would be terrific. What would that do for pricing? Again, I would think it would only help, because you've got a bigger market, more participants. And of course, all of these market participants, all of these stakeholders, for the most part, have a vested interest, I think, in price transparency. And so I do think we're going in that direction. It's going to be a mixture of, market chatter, futures contracts, but just a bigger market with more participants is ultimately going to lead to pricing transparency.
Where do you see the opportunity in lithium in terms of the equity side of things?
Well, look, I mean, very, very little works right now, right? I mean, at $8,500 a ton, or I think spodumene may have just cracked $700 a ton. Again, with this price bump, to think about it a slightly different way. You need $17,000 to $20,000 lithium, I would argue, to build greenfields projects here in North America. And let's just keep it at 20 grand a ton. So we are nowhere near that right now. And I'm not saying that you want to wait until lithium gets to $20,000 before you start spending or investing. Obviously, today, planting those seeds is what is most important. I still really like hard rock for that reason. I just think you have that reason I mentioned beforehand. You have a lot of flexibility in terms of what you can produce. I think the biggest challenge in lithium, though, isn't necessarily, is it brine, is it hard rock, is it clay? It's getting the refining capacity built. Okay. And so we have seen through several boom and bust cycles in lithium, hard rock companies, for example, that decided, okay, we're going to build an open pit mine and we're going to build a refinery either next door or, a couple of 100 miles away. And, those are two very different engineering challenges, I would argue. And because of that, it's just never worked in the Western world. And so China, again, really dominates. That's where the bottleneck is in lithium, and China dominating, I would argue, the lithium space. So, if we bring this back to the beginning of this conversation, right, and say, okay, well, how does the U.S. government help the lithium business? from an investment perspective. I don't necessarily think it's equity investment in domestic lithium mining. Could be, but I think it's refining. I think that is the crucial element. And, a 30,000 ton a year lithium refinery, let's be generous and call it $1.5 billion in CapEx. It's probably lower than that. But nevertheless, if the DOD is going to fund something like that, they've got a $1 trillion budget, hopefully hundreds of millions of dollars at their disposal for more critical materials investment. It seems to me like building that refining capacity, again, as long as you can pair it with a specific asset, right? I think that's the way to go. So kind of a roundabout way of answering your question, what do I like? I really think the most important piece is the refining aspect. And I'd love to see kind of a similar model for what the DOD has done with rare earths in lithium.
Right. Well, I completely agree. Whether it's lithium, copper, nickel, any of the base metals in my experience or what I see, it's that secondary refinement that is absolutely missing. And it makes it, and this is also going back to our first thing, the government, and this is my own view, how dumb they are. They promote the push towards mining, but if you can't refine it, that's where all the end value is seemingly made.
Of course.
The most money, the most jobs, the most everything is on that back end, and it seems to be missed. And
one more example. Like I've done a lot of work on the recycling side, right? Battery recycling side, and so there are companies here in the United States that have shredding capacity. They'll either take end of life packs or battery scrap, feed it into a shredder, and you get different output, right? You get copper and aluminum foil that will go right off to a copper smelter. You get the plastics, which is sort of the waste. That's a big question right now as batteries continue to proliferate. But the real value in the shredding is the black mass, right? The black mass is the material that contains the nickel and the cobalt, the cathode and the anode material. Where does that go to get leached and processed? It goes to Asia right now. Okay. So that's another example. I don't want to just limit, this to lithium. Another great example is graphite, right? Just yesterday, the Department of Commerce released their, final findings that yes, the government of China is indeed, or not the government, but Chinese interests are indeed dumping anode material here in the United States at below cost, and as such have recommended a 93% tariff on the import of anode materials. So when you take that 93% bump, if you will, or tariff, and add it to existing tariffs, you're at 160%, right? And so maybe that, again, that's good or bad depending upon where you sit on the supply chain. But, because we don't have the graphite mining and graphite and anode processing capacity at scale here in the United States, what we have effectively done is we have made batteries more expensive, right? Because now we're going to have to continue to import the anode material, but there's going to be a 160% tariff on that. And, I'm not going to get into the arguments about who is ultimately going to pay for that. That could go a number of different ways, but there are a lot of different areas that the U.S. government can help here from a mining perspective or from a critical materials perspective. And to your point, Brian, it doesn't matter if it's copper or nickel or graphite or anything. That refining piece is absolutely crucial.
Yeah, absolutely. And honestly, listening to the different talks on the tariffs, I just don't see any scenario where the end customer or the citizen doesn't end up paying for that in some shape or form. Yeah. But again, that's a digression. It's maybe a different conversation.
Right? If you just think about the backdrop for building capacity here in the United States, like think from a macro perspective about where we are. So, real interest rates are higher today than they were, say, 1 or 2 or 3 or 4 years ago, right? So that feeds into your cost of capital. So it's more expensive to fund. It could be gold, it could be silver, it could be platinum. I'm not just saying this is a critical metals thing. But my point is that just the CapEx has increased dramatically in the last couple of years. So that's issue number one. Issue number two, which you have rightly pointed out, is the volatility in metals prices. They're all over the place. And so decision making is obviously much more difficult. And then third is the regulatory uncertainty, which you also pointed out with respect to the tariffs, right? I mean, are copper tariffs going to be at 50%? Are these graphite tariffs going to stay at 160%? I mean, I would argue if the mining industry, if the critical materials industry knew what the number was, and, beyond, say, next Tuesday, then they could at least make a decision, right? And they could say, okay, we know that our cost base is going to be 20% higher because of these three factors, interest rates or, tariffs or export controls or whatever it is. And then they can make a decision accordingly. And I would argue that if there was policy certainty with respect to tariffs coming out of the White House, that would also really help these other agencies like the DOD make investments in critical materials projects as well, because then they could look out and they could say, okay, well, we'll stand up for the offtake, or we'll do a price floor because we believe that, we need these materials. And the price floor is predicated on where we see the macroeconomy today here in the United States and going forward when you factor in tariffs and some of these other challenges.
Over the last week, we saw a huge advancement, or I'm told is a huge advancement in AI with the release of Grok 4. I've read the headlines. I've listened to a couple podcasts. It's truly amazing what this Grok 4 is, I'm told, able to do. How do you see AI, whether it's Grok 4 or any other AI, how do you see that affecting, the world we live in? The investment world, I guess, is maybe most pertinent to us.
Yeah, I mean, I'm assuming I've always been a technology bull or a techno optimist, for lack of a better phrase. I feel like, we can talk about inflation and interest rates and all of the macro, monetary policy and fiscal policy. But at the end of the day, technology is this very powerful deflationary force. Okay. I mean, look at the price of solar over the last 30 years. Look at the price of batteries over the last 30 years. Look at the price of semiconductors, et cetera, et cetera. They continue to collapse. And so I would think, and again, I'm not an AI expert at all, but my sense is that these AI advancements, while they're going to continue to help these technologies proliferate throughout society, look, there arguably is a cost associated with that, right? And I think just in our world, our sort of raw materials world, technology and certainly infrastructure, right, can be resource intensive. I mean, we sort of alluded earlier to the amount of copper necessary for data centers or lithium used for batteries for backup. I mean, anybody can kind of get the back of the envelope and start looking at numbers. And again, if we think AI is really going to proliferate and it's going to be built on the back of data centers, you're looking at huge demand for some of these energy metals. So I think that I'm sort of doubly bullish in that respect today, despite, again, some of these near-term jitters around tariffs and price volatility and so on and so forth. So it's a little bit of a different investment argument, I think, about, where do you invest along the AI supply chain? Something I'm not entirely sure of myself, but I do know that these technologies are resource intensive. And so that's why I think it's very important to have a clear understanding of supply and demand trends for all of them across these different demand dynamics going forward.
Chris, House Mountain, tell us more about the services that you offer.
Sure. So I have been an independent analyst and an advisor to companies and investors along the battery metal supply chain for the last 15 years. I spent the first 20 years of my career in New York, and I've always been obsessed with this single question, right? And the question is, what happens when commodities, geopolitics, and technology go like this and collide? What are the opportunities? What are the threats? And so on and so forth. And so I remember, I was working in New York. It was right on the tail end of the financial crisis, 2009, 2010, and broke away from what I was doing with the intention of building a research and an advisory platform to really address that question within the context of security of supply of critical materials. I always felt like, it's great to have battery factories or drones or whatever it is, right? But if you don't have a line of sight on the raw materials, it's going to be awfully hard to build the downstream pieces, right? So anyways, I remember looking around and, Goldman Sachs, for example, they didn't have a lithium analyst, or Morgan Stanley didn't have a battery team. Or maybe they did, but they were in South America or somewhere tucked away in Asia, right? It's not like it is today where these guys all have their huge teams and they have the 90-page primer on direct lithium extraction. And so, I just started begging mining company CEOs to come on site visits and going to conferences and just volunteering to moderate panels and just ask questions and learn and better understand, is there even an answer to this question that has consumed me now for decades? I'm in the process of writing a book about it, so I'm not sure when it's coming out because so much keeps changing, but nevertheless, it's an exciting time to be thinking about it. And so anyway, I work with two groups. I work with typically pre-revenue companies along the supply chain, could be mining, could be battery technology, could be recyclers, helping them think through issues of corporate strategy and positioning. I'm based here in Washington, D.C., so sort of having an ear to policy has also been helpful. And then, the other group that I will work with is investors, and that could run the gamut from hedge funds to high net worth to private equity funds, all of whom believe in everything that we have talked about today, right? The idea of electrification or even the national defense argument. I mean, there's a lot of belief on that, the sustainability of that long term, and helping these investors figure out where to play along the supply chain. I mean, maybe they don't like mining, but they really like recycling. And so they want to understand that. And so I've been on the board of a recycling company before. And so I really understand that ecosystem, and I'm able to kind of leverage that knowledge to help educate the masses. And so that's really, really what I do. And so happy to, maintain or continue the conversation with anybody here, out there on LinkedIn. I've got a website. It's discoveryinvesting.com. You can find me there. And, happy to continue the conversation.
Excellent. Chris, it's been an absolute pleasure. We will link to House Mountain in the description below, along with your Power and Current podcast, which is a passion project for yourself. Yeah,
I forgot to mention that. That's a labor of love. And I started it with the Clear Commodity Network, actually. And my goal there was I just want to get better at asking questions, because I figure when you ask the right questions, you get really good answers. So anyways, that's a nice little addendum to what I'm doing.
Well, I can certainly attest to that doing this podcast.
Yeah.
Chris, thank you so much for coming on the show. We should definitely do this again soon.
Thanks, Brian. I appreciate it.